Give two people the exact same amount of money. One spends it, the other invests it. 10 years later, one of them still has roughly the same amount. The other has multiple times more, without lifting a finger after the initial decision. Same starting point, same effort along the way, wildly different ending. This isn't luck, and it isn't some secret only the wealthy know. It's math. Simple, quiet, relentless math that's been running in the background of every fortune ever built. People love to explain wealth gaps with stories about hard work, or bad luck, or unfair systems. All of those play a role, but underneath almost every one of them is a mechanical force that has nothing to do with fairness at all. It's called compounding, and once you actually see how it works, you'll understand why the gap between the wealthy and everyone else doesn't grow slowly. It grows on a curve. Let's break down exactly how that curve works, and where the real advantage actually comes from. Here's the core idea, stripped down to its simplest form. If you have money sitting in something that grows, you don't just earn a return on your original amount. You earn a return on your original amount plus every return you've already earned before. Put $100 somewhere that grows 10% a year, and after 1 year you have 110. But the next year, you're not earning 10% on the original 100, you're earning it on 110. Then on top of that number the year after. It looks small at first, almost boring, but stretch that same pattern across 20, 30, 40 years, and the curve stops looking like a straight line and starts looking like it's shooting upward. Wealthy families aren't usually earning some incredible secret return that regular people can't access. They're mostly just giving compounding more time and more money to work with. Here's where the gap actually opens up. Most people's income comes from wages, trading hours directly for dollars. Wages compound the way years compound. They don't. Every dollar you earn from a paycheck is a dollar you have to actively work for again next month. But assets, stocks, real estate, ownership in a business work differently. They generate returns whether you show up or not. And here's the part that matters most. People with more starting capital simply have more assets working for them at once. A small amount of savings sitting in the market grows quietly, but it takes decades to become life-changing. A much larger starting amount reaches that same life-changing scale far faster, because the same percentage return is worth dramatically more when it's applied to more money to begin with. And it's not only capital that compounds, access does too. Someone with existing wealth typically gets better loan terms because banks see them as lower risk. They can afford financial advice most people never get, which helps them avoid costly mistakes and find opportunities earlier. They can absorb a bad year, a market crash, a failed investment without it wiping them out, which means they can take risks that eventually pay off. Risks a struggling family simply cannot afford to take. None of this requires anyone to cheat or break a rule or do anything secretive. It's simply that money, once you have enough of it, starts opening doors that keep generating more money, more safely, more often than starting from nothing ever can. And here's the twist that makes this so hard to fix with good intentions alone. Compounding doesn't just help the wealthy get richer. It actively widens the gap between them and everyone else, automatically, with no one making a deliberate decision to cause it. Two people can work equally hard, make equally smart choices, and still end up worlds apart, purely because one of them started with a bigger number for compounding to act on. This is why wealth inequality tends to grow over time in almost every economy, even healthy, functioning ones. It's not a conspiracy, and it's not a moral failing on either side. It's what happens when a mathematical process that rewards existing size is left running, uninterrupted, for long enough. The rich don't necessarily get richer because they're smarter or working harder than anyone else. They get richer because they started the clock earlier, with more on it, and the clock never stops. So the real advantage was never a secret trick hidden from ordinary people. It's time, starting capital, and the willingness to let compounding run for decades without touching it. That's simple to explain and genuinely difficult to act on, which is exactly why so few people actually do it early enough to matter. So, what do you think? Is this gap something that should be corrected or just an unavoidable side effect of how money naturally works? Tell me below. If this helped it click, subscribe. Every week, Otto breaks down how the world actually works. Next time, why ads seem to know you better than your own friends do. See you then.